Hello and welcome back to Leviathan News, also June 7th today. And we're back for a couple of interviews. So, first, we have Sam from Sturdy Finance here, who is going to talk about LSDs and also some lending and leverage as well, too. But I'm going to let Rex take this one off. And
Cool.
welcome.
Yeah. So, good to see you guys again today. But yeah, so I think, so Sturdy Finance will let Sam kind of give like the 2 sentence, just like basic, what is it?
So there's
And
two Sams here today.
sorry.
I can be Samuel. I can be Samuel for this
No,
show.
no,
We
no,
also have
we're
Sam
doing
as well,
this.
too.
You're Squid Sam and you're Sturdy Sam.
There we go.
Okay. I will let Sturdy Sam give like the TLDR on what Sturdy is. But I think like important context for the audience to like understand this conversation is like it is LSD season. Like everyone's going crazy, and like you don't need us to tell you that. And like as far as the conversation we've had on this show so far is really focused on like the first question, which is like which LSD and why, and decentralization and the primary token. But like the very obvious next question is like, what can you build on top of LSDs, and like why are they important for the ecosystem and for DeFi? And so, like, kind of with that as background, Sam, like, Sturdy Sam, would you please give us first just like the very brief basics on what is Sturdy, but then, like, can you help us understand where Sturdy sits in the DeFi ecosystem? And take it from there.
Yeah, absolutely. Well, thank you guys for having me. Sturdy is a lending protocol that users use for leverage yield farming. So there are two ways to use Sturdy as lenders, where you can lend stablecoins or ETH and earn yield on it, just like you would on another lending protocol. But then what kind of makes Sturdy a little bit different is really the borrower side. And what borrowers can do is deposit interest-bearing assets as collateral, like LSDs, for example, and then lever up. So depositing, for example, Curve ST ETH token as collateral, borrowing ETH against that position, and then recursively looping to get a leverage position. And you can actually automate this in one click with Sturdy. And what this position allows you to do is earn leverage yields on LSD. So you might only have a 1x exposure to ETH, right? So it's not like you're overexposed to the price of ETH, but a 10x exposure to ETH yield. So you can be up to 50% on ETH yields. And the only way you get liquidated is if the underlying LSD depegs relative to ETH. So if ST for example, drops to like 0.9 ETH.
Mm-hmm. And when you, so Sturdy, like I know you briefly mentioned before we started recording that a V2 is like in the pipeline. So I don't mean to like kind of denote along those lines, but thank you, Squid Sam, for bringing this up. Like on the very face of it, it seems like we have like two kinds of markets here, right? Stablecoin markets and like Ethereum-based markets. And so can you talk a little bit about just like the history of Sturdy, like where you guys came from, and like ultimately, like now that we are post Shanghai and like we are in LSD season, like where do you see Sturdy like really like finding its stride?
Yeah, we launched back in March 2022 on Phantom. And originally the focus was pretty different. It was less about leveraged yield farming and more just using interest-bearing assets as collateral in general. So for example, like you could borrow USDC against like ST. And so we were pretty early actually to using LSDs as collateral and just interest-bearing tokens like from Yearn more generally. A couple months later, Phantom started declining a little bit, and so we launched on ETH mainnet in June 2022, so about a year ago. And that's when we really first introduced some of our leverage yield farming strategies, and it became really popular very quickly with farmers who started using the platform. We became the largest mainnet lending protocol without a token. And we pretty much held that until we launched a token earlier this year, which is still currently not transferable.
Very cool. And so I guess just for those that are like really kind of new to DeFi or new to finance, like would you mind just like describing like what is leverage yield farming, and like let's say how you transform your 4% yield on a LSD into something more attractive?
Yeah, for sure. So you can imagine depositing your LSD as collateral, right? So let's say you're depositing ST ETH, you're getting 4%. And then when you borrow ETH against that position, let's say you're paying 2%, you can then put that ETH back into an LSD, right? Like ST ETH, and then put that LSD back into
Mhm.
Sturdy. And so you're recursively borrowing by depositing collateral, taking out a loan, putting that loan back into the collateral asset, back into Sturdy, and that's how you get leverage. And rather than having to do that whole process manually, which is really time and gas intensive, there's a tool on Sturdy to automate that, and that does it all with flash loads in one click.
Cool. And just
What
like,
level,
oh, go
what
ahead.
amount of leverage?
It's up to the user. So that there's sort of like a slider bar, but you can get up to 10x on most assets. There are some that are less so, but up to 10x.
And so, am I understanding that right? That like with 10x leverage, net, like you have a significant portion of this is going to be subtracted out to fees, but essentially, like you're taking your 4% yield on ETH and like transforming that into 40% yield.
Yeah. And so, as you mentioned, it depends on fees. The way that Sturdy works right now is that a portion is automatically taken and used to pay lenders. And so typically the borrow rates are at 0%. So you're not paying any borrow interest because you're essentially losing out on a portion of your yield. This might change. There's actually a proposal in governance that would tweak this and implement kind of a more traditional interest rate mechanism like you see on Aave or Compound. But at present, that's how it works.
And what is your thoughts on like that, your design that you have now versus like interest rate design? Like why is the community thinking about that change, and like do you think it's the right one or not?
Yeah, in a world, the rate structure we have now is more predictable, whereas a borrower, you're not paying anything, your debt doesn't increase. And so, I think that's great. Everyone loves interest-free loans. The issue that we've been seeing is that it's really difficult to attract lenders. And a lot of protocols in DeFi are struggling with this, where they're capacity constrained on the lending side. And so having more incentive by introducing interest rates for lenders, we think is going to grow lending volume. The other thing is right now we have interest rates when utilization is above 80%. So when more than 80% of a given pool is being borrowed, interest rates turn on and they spike quite a bit. And so one thing you see, and I think earlier you were showing that, Sturdy's web app and like the DAI market, for example, has really high interest rates at the moment, like 10%. And so having that structure where occasionally the rates spike up a lot, it creates a lack of predictability for borrowers. And so we're hoping that a rate structure that's below 80% utilization as well and is a little bit more gradual will make things more predictable.
Can we talk about oracles? Because where do you get all the pricing data for your pairs? Because I know that's one thing at Frax, which is kind of like held up adding a lot of assets, is that the lack of data for these curve pairs. Like I know the curve V2 pools have like a TWAP oracle that they can use, but are you just using like single oracles for these, or how are you getting that pricing information from?
Yeah, so we exclusively use Chainlink. The way it works for like a curve LP is that since we're using all like pairs, right? Like, stable swap pairs. You take the minimum of every token in the pool, right? So let's say it's like USDC and Frax. So you take the minimum of that according to Chainlink, and then you multiply it by what's called the virtual price, which is just the scalar that Curve provides, and that gets you the value of the LP token. And this is like sort of the safest way to do it. Chainlink has an whole article about how to do it, and this is their recommendation. But it's designed to be resistant to flash loans and kind of the typical pitfalls that you see when developing oracles for more complex tokens.
Yeah, because I know the curve pools have like an oracle built into them, their newer versions, but I haven't seen anything for the balancer pools, which you also have as well too. So have those been added to Chainlink as well?
Yeah, it's the same thing. So there's no Chainlink oracle for the pools themselves, but what you can do is use the Chainlink tokens for the underlying and construct a secure oracle based on that. And it's very similar. The they have like very certain in order to get that.
Hmm. And so, like, one of the things, I mean, like, in this sense, like, okay, so I want to talk about the LSDs a little bit, because I think you guys have added those recently. And one thing about the LSDs is that, like, you have, say, these curve pools, right? And then you're asking people to deposit WETH, or like ETH, to be able to like fund the leverage on that, right? As time goes on and we get to a higher and higher utilization of LSDs across the board, we go from like the 10% that we are right now up to the 40s to 60s. It could be hard to source that kind of Ethereum, like, or WETH, to be able to make these trades. How do you see that playing out? Because one thing that I've thought about is like having an interest rate swap market where you could, deposit, say, like, stake Frax ETH and borrow Steth. And if as long as the interest rate for the one that you're borrowing against is lower, you should be able to like pocket the difference. Maybe it's like 0.5% or something. And with enough leverage, with like 25 to 50x leverage, then it becomes something which looks like a reasonable trade to take.
Yeah. So I mean, I guess so. The question is basically what happens as LSD yields go down.
Yeah,
over
exactly.
time,
Yeah.
right? Okay.
Right. So yeah.
Mhm.
Yeah. So one of the nice things about using curve LPs instead of the underlying is that we're not entirely just reliant on the organic yield from STETH, or whatever the LSD is. We're also earning, and by we I mean the user, right? The user who's levering up is earning yields from the LP token, right? From the emissions, whether that's CRV, CVX, VAL, Aura. And we don't think that those are going to go down as LSD natural yields go down. We think the opposite may actually happen. And we're already starting to see this already with projects like Rocket Pool that are now starting to increasingly incentivize their pools on Aura and Balancer. So, we think that the competition for LSDs is only going to increase over time. And so you're going to see, even as those STETH yields maybe go down, that the yields on the LPs are still going to stay competitive, because all of these LSD providers are kind of battling out and trying to get as much liquidity as possible for their token.
Yeah, I understand the curve war aspect of it. I think it's more that as these LSTs mature and they get out of the growth phase and they kind of like level off in the sizing, the yields pretty much all should converge. Like, if there's any really difference in yields, the efficient market should converge to bring them all kind of in the same way. And I think you've seen this a little bit looking at Curve's bigger pools. Like, if you look at like 3Curve or the Frax USD pool, they've gotten to a sufficient size where the yield, the extra yield that you're getting from CRV is only maybe like 0.5% or like 1%. And so if that's the case in a more mature state, the LSDs that you have, say, like all these pools, right, could be very pricey to borrow WETH, right? Because people don't want to be in WETH because there's a kind of a base interest rate of, say, like 4%, 5%. And if that's not being paid out from Sturdy just by being in WETH, I mean, it would have to be more, right? So that base, like, how do I try to say this? So there's like a base borrowing rate for WETH, which it should be. So if you think about the yield that you're getting from your ETH, that should be your kind of base rate. Because, like, why lend WETH, or why lend ETH when you could make more staking? So I'm looking at the APY here on ETH for your markets, and it's suboptimal, really. Like, you're earning 2.82% when you could just turn around and deposit that into the state, like any staking contract, and earn like 4 to 5. And I understand that there's token incentives right now, which could potentially raise the like profit profile of that trade. But assuming in a more mature state, when these token incentives taper off and are negligible, because they can't run forever. How, like, where does the demand on the lending side come from for WETH?
Yeah, so this is one of the main motivations behind the proposal I mentioned, to tweak the interest rate mechanism that should increase the lending rate that that lenders are earning. And I think that fundamentally, like I think that the interest rate for, or the yield that you'll get for like LPing an LSD will be higher than the yield on the LSD itself. I think it's just like higher risk, and so the market will price it that way, and that's what we've seen historically. And so long as that's true, then it will, still
I
be
don't
possible to
think
have a
that's true. I
profitable
mean,
position.
like, look, we've seen from Frax, I can bring this up, that the I'm going to share a tab here. Let me just refresh this. The interest rate between the Curve LP and the Stake Frax ETH yield has pretty much been like 1-to-1 ever since. It deviates a little bit sometimes if there's a change in like if there's a bunch of yield that's collected through the MEV or something within a week, but everything corrects and it typically follows each other over time. So I don't know why this isn't pulling up. We're not getting charts right now, but what you've seen from the yields is that like the market is really efficient, right? If you're earning 5% from just staking, because like just staking in the LSD is kind of like the base rate, and so you have to assume that like by being in Curve, it needs to be like similar or maybe a little bit above, maybe like 0.1 or 0.2% higher, maybe 0.5% higher, depending on the LSD. But so I guess coming back, like what, like the demand for, okay, so can we come back to that proposal that you were talking about? Because I don't think I understood what you plan to do with the interest rates.
Sure. Yeah, it would essentially increase the interest rates for lenders. So right now, for like some of these pools, let's say the Rocket Pool Curve on Aura, you can earn like 6% APY. So then maybe how it would play out is like that the lender will be earning 4.5%, and then borrowers at 10x are earning like 15% yield, something like that. Yeah, that's like a potential breakdown where it's profitable for both, where the lender could ostensibly earn more than they would staking, and the borrower is still earning, really competitive double-digit yields for leverage.
Mm-hmm. So what would a product in a more mature, sturdy state or sturdy lending market look like if that's the case? If you just assume that like West lenders are not going to accept less than the minimum staking rate.
Yeah. So long as there is some derivative product that's earning more than the staking rate, then that works, right? And I think I'm like very confident that will be the case. I think there are so many derivatives coming out now, whether it's like Unsheath or Swell or any of those that that will always exist. And so long as those products exist and there's demand for leverage for them, then you can have a product where the lenders are earning more than the base yield and the borrowers can still leverage profitably.
Do you prefer the term LSD or LST or the lesser used LUST?
Yeah, I don't have a huge preference. I think with LST, it's a like regulatory thing for the protocols like Lido and Rocket Pool that have them, where they don't want to have derivative in the name.
And
So
LSD is
we
a
sort of
controlled
just
substance.
yeah, exactly. So I don't have much preference. I just kind of go along with whoever, whichever one is more popular, will probably end up using.
Yeah. So I think it's interesting to see with the LSTs just the wide range variety that you've seen kind of pop up, and there's a whole host of them that we've published. I mean, we published a guide yesterday called like LSD-Fi Summer, which kind of went into all the different like NFT-Fi markets that you're going to find. Like, what do you think are some of the innovations that are coming for the LSD-Fi? Like now that we have these like they're not really like primitives, right? Because like we had Dan Elitzer here on a previous episode. He was saying like to be a primitive, it has to be like fully trustless, no governance, like it's just code and nobody can do anything with it. But with all these LSDs, there's an element of centralization there for any of the providers, and they also have more smart contract risk. So they're not like true primitives, but they're like quasi primitives. So like, what else do you think is going to get built out for LSD-Fi in the next couple quarters in a year?
Yeah, I mean, right now, I don't know. I haven't been like super excited by any of the projects. Like a lot of it's sort of like just liquidity forks or something like that. So I feel like that's a little bit saturated at this point. obviously you have like the restaking stuff with Eigenlayer and all the products being built on top of that. So I think that will be kind of interesting. I have sort of mixed feelings about that. Vitalik had, I think, an article about that, sort of cautioning based on the risks of that, which I sort of agree with. So yeah, I'm very curious to see how that will play out, though. I think either way, it'll be super interesting. One thing that we're working on as part of Sturdy V2 is making a really modular framework for lenders, in that they'll be able to choose exactly what assets are used as collateral for their deposit, right? So let's say I'm depositing like USDC, and I only want borrowers to be able to use like ETH and STETH as collateral when they're borrowing my deposit. I'll be able to select exactly that as part of V2. So we're super excited about that. That's like kind of like long-term, 3 to 4 months. In the short term, one thing we're coming out with is a structured product that will automate the leverage taking side. So right now, I mentioned it's kind of like gas intensive to lever up on your LSD, and maybe like borrow rate spike and all of a sudden you're losing a ton of money. What we're going to have is a product that you just deposit ETH to, and then will automatically lever up into the most highest yield bearing LSD. If interest rates start spiking, it will delever automatically. And if another LSD comes along that's earning more yield, that's for as collateral, it'll automatically switch to that. So we're really excited about that. It's like just a passive product that we think will have super competitive yields for LSDs and ETH.
Cool. Yeah, no, I mean, awesome. I mean, I think that I very much agree with you that like there's not that much that's super exciting that's happening. Like, I don't know. I mean, I think my thesis is that the next bull run is really driven by macro always, but is like will be around like the other side of LSDs, which are the validator and like the validator as a platform. And like the reason why that's like the validator is so critical is like that's where Ethereum touches the real world and like real compute. And I think that like, of course, DeFi will like benefit and have like a renaissance because of it, but like the energy is going to come from the other side, not this side.
Yeah, it's interesting with Frax ETH. I don't know if you saw their V2 thread that I think third Sam, founder of Frax, posted. But yeah, it sounds like they're kind of thinking along those lines in terms of like thinking about LSDs as a lending protocol and making validators sort of a more engaged portion of that. So yeah, I think I agree. I mean, I think that will definitely play a core role.
So like, how do you guys build a moat? Because there's a lot of money markets out there, and there's a lot of them. They're going to be incorporating like different variations on LSDs, like the curve pools, just all these different products. So like, how will we be able to compete with the majors, which have access to a lot more capital and potentially like other just like a bigger like base who would be able to use the products? So like, how are you going to navigate that and build a moat?
Yeah, great question. For Sturdy V1, our current product, I think our edge was that we were really early to LSDs. We kind of figured that they would replace ETH and borrowing before a lot of other people did. And I think that's what enabled us to be the largest mainnet lending protocol without a token for so long. That edge is like disappearing. There's a proposal on Aave right now to add like Aura LPs as collateral. And so I think, more and more protocols are comfortable with LSDs and adopting them as collateral. And so that's, a big part of why Sturdy V2 is something that we're so excited about, where we're basically just recreating the lending stack from the ground up. It's going to look very different from Aave or Compound on a structural level. Maybe just to describe the motivation a little bit, if you're lending USDC on Aave, right, there's sort of like a single base rate that you earn, right? You're going to earn 2.5% or something like that. But maybe you're like more risk seeking. And so you'd actually prefer to take 4% change for being exposed to some more risky collateral. Or maybe you're really risk averse and you'd actually prefer to take 1.5% if it meant only being exposed to a subset of the collateral on the platform.
Yeah, but they have that. They have that with the V3 pools. Yeah, the isolated pools. Yeah,
they have like isolated mode. Yeah, but that's very different because it doesn't allow you. If they add a collateral asset to the protocol, you're exposed to it no matter what, right? You don't have the optionality. And an isolated mode, you still have to do it manually, right? Like there's no sort of integrated way to deposit to be exposed to isolated pools and sort of automatically balance. And so that's what Sturdy V2 is going to be about, is that no matter what, like every single asset, you'll be able to opt in or opt out. And so that gives you a ton of flexibility, right? It makes asset listings totally permissionless. It means you can sort of construct multiple protocols on top of the core base layer. And so, yeah, we're really excited about that. And I think it will be a very new kind of lending protocol that opens up a lot of opportunities for lenders and borrowers.
Yeah, I like the idea of the leverage product. I think the best. That sounds, like for retail in DeFi, people like these like dead simple things where you just like chuck some ETH into it, like Yearn, right? And it just does all the work for you. Especially in this, where like if it's like the DAO that's managing the product and then adjusting it based on the interest rates, that seems interesting. I think then you have like another one of those derivative products that you could use in other places that other people could like build on top of you, right? Because like for most of DeFi, it's not just about being downstream and using somebody else's product. It's also being upstream and having people use you, implement you.
Yeah, no, absolutely. I mean, that's something we're very excited about. And I think will be really key for V2 in particular is having protocols that want to use their assets as collateral, which is something, we get all the time is projects interested in that, but maybe they're kind of too early. They don't have Chainlink oracles. And so having something where you can just permissionlessly spin up a market, I think that will be compelling for a lot of projects.
Oh, so anybody could come and spin up a market?
In under V2, not today,
okay.
but in the future.
So I was about to say you should add Frax ETH.
Yeah, I think obviously no brainer for V2, and there's actually a lot of integrations with Frax that I think will make sense for V2 that we've been exploring with them. But even for V1, I think once that Chainlink Oracle is ready, it would probably make sense and get approved by governance.
Didn't you just propose something on the Frax forums? I think I wrote about it this last week, didn't I?
Did we?
Oh, it wasn't. Sorry. It was something else.
Cool. Well, like with our final like closing minutes here, can you just talk about give us just like a flavor of like what you're excited about like over I guess the rest of 2023, and like when you look forward to like the things coming down the pipeline, like what are the things that are like really energizing to you?
Yeah. I think definitely Sturdy V2 is like the highlight for me. So, I'm super excited about that. I think it will be very interesting to have a product that gives lenders more control over what's happening with their funds, and that enables newer projects to spin up lending markets for their assets. Really today, neither of those exist in a way that's like liquid and accessible to users. So that will probably come towards like in around 3 to 4 months is the timeline we're looking at right now.
Nice. Well, good luck. You know where to come in 3 to 4 months.
Yeah, absolutely. Appreciate you guys having me.
Yeah, thank you for coming on.
Yeah, thank you.